Now we all know that whenever a payment is made to a non-resident, there are withholding tax provision which applies. So how does the withholding tax, or the tax which is withheld from payment to a non-resident, is governed by the provision of the Act? Let's look at that. So the treaty provision, okay, I told you that a non-resident has a right to opt for the provision of the Act or the treaty, whichever are more beneficial. So the applicability of the treaty provision has to be seen at the time of withholding and not when you are filing your return of income. ROI here stands for return of income, right? What that means is that it is not that when I'm withholding tax, I have to do it as per the provision of the Act and the beneficial provision under the treaty, the non-resident has to claim by filing his return of income. No. At the time when the withholding tax itself is done, we need to see what is the taxability under the Act, what is the taxability under the provision of the treaty, and then whichever is more beneficial to him, apply at the time of withholding and not at the time when the return is to be filed. The second thing is that if there is a withholding tax order, now under the Income Tax Act, there is a provision that if a non-resident believes that his income should be taxed at a rate which is lower than what is prescribed under the Act or treaty, right, then he can actually approach the assessing officer who has a jurisdiction over the non-resident to pass a withholding tax order specifying that the withholding which should be done by the Indian party should be at a lower rate, right? If the withholding tax order is given to a non-resident, or instead of obtaining a withholding tax order from the assessing officer, he obtains a CA certificate in Form 15CB, right? Either of these two are not conclusive of the tax liability. So if an assessing officer says that you should pay tax at 20%, right, whereas the non-resident believes it should be 10%, this does not mean that the non-resident's liability is fixed at 20. He can still file his return where he says that my income is taxable at 10%, you passed an order to pay 20%, but this balance 10% should be refunded back to me. This order from the assessing officer is not conclusive of the tax liability. Similarly, if he obtains a CA certificate which says that the tax rate should be 0%, right, whereas at the time of return he assumes that the tax should be at 10%, then the CA certificate in Form 15CB is also not a conclusive evidence of the tax liability. That will be governed by the provision of the Act or the treaty, which may be interpreted in detail at a later stage. And if there is any tax withheld, right, by virtue of this order or the CA certificate, which is more or less than what should be rightfully paid, if there is excess tax which is withheld, the balance will be refunded. If the tax has been paid which is less than what is due, the non-resident will have to make a payment for the further taxes. So to summarize, from a withholding tax perspective, 1. When we withhold taxes, we apply the provision of the treaty or the Act, whichever are more beneficial. If you obtain an order from an assessing officer which says that the tax should be withheld at a particular rate, or you obtain a CA certificate for the tax rate, in either of these two cases, if the actual tax is different from what is specified in these two, then actual tax is what is to be paid at the time of filing your return, right? If you've paid more, you get back the balance. If you paid less, you need to pay the further payment.